Welcome back to Market on Close. We got two indexes higher, two down with about 10 minutes left. We'll keep our eyes on it as we have our big picture discussion with Joe Mazzola and Kevin Gordon. Joe's the Director of Trader and Education. Kevin's a Senior Investment Strategist. Charles Schwab, afternoon, guys. Great to see you both here. Kevin Gordon, get us started as we head into next week's big Fed and earnings week. How's the market looking overall in your mind?
Well, also it's a big data week because we get the jobs report, we get ISM, we get job openings. It's a pretty big week. But I think, for today, maybe you have a little bit more selling in some of the areas, with the high flyers, maybe taking the brunt of it just because tech seems to be the notable laggard. But I think down the cap spectrum, there's a lot more strength. Certainly, even though you've continued to hit record high after record high for something like the S&P, not surprised to see maybe a little bit of a softer tone. But I think the broader story and what's been at least more impressive for the market is you haven't really gone through any sort of corrective phase that you would normally go through after seeing sentiment getting as stretched as it did, especially at the end of the year. I mean, I think that's a nice way to sort of go through a corrective phase without a full-blown one at the cap-weighted index level, but you've seen, definitely some weakness within the indexes themselves, certainly within something like the Russell 2000. So I think it's been a pretty healthy sort of rotational correction under the surface as some of that froth has been worked out.
Like that point. NVIDIA down 1% with chips, so a little bit of a reset ahead of AMD next week. What do you think is, I like this game, Joe. One of my favorite games is let's guess which event moves the market the most, because it allows us to do a little prediction without saying which way or how much. But you got a Fed, you got jobs, you got big tech earnings. I mean, what's the highlight to you?
I think number one is big tech earnings. I don't think there's basically zero expectation of any type of Fed movement next week. I mean, the language could, to a certain extent, push bonds one way or the other, but I don't think you're going to hear much out of the Fed meeting next week. But it's absolutely about the mega caps. You got 5 of the 7 all reporting next week. And honestly, Oscar, heading into next week, you're not seeing a lot of bump in implied volatility from the options market. I mean, it's basically kind of pricing in, I would say, average to below average moves when you're looking at straddle prices. So there's not a lot of downside fear heading into those earnings.
Yeah. What do you think, Kevin Gordon? Is that the big story next week, or could a shocker on the macro side refocus our attention away from the tech giants?
Well, I think to Joe's point, it's probably not a Fed decision itself that is any kind of needle mover. It's probably more around the language. I think there's still, all of this hysteria over whether we're going to get a rate cut in March. We've been saying it's not really as much the timing of when you get it. It's really the conditions around sort of the cut itself, and whether you get a cut at every other meeting this year, or if it is a series of cuts in a consecutive fashion. That's, the economic context is much more important. So I think the way that Powell balances language around the inflation mandate, but also the labor mandate is important, because I think that, what's been important in this cycle is that the disinflationary trend, evidenced by what you saw with the data this morning, that's really what's creating the conditions to allow the Fed to cut. What ultimately pushes them to cut, in our mind, is softness in the labor market itself. Because if you still have a relatively resilient labor market and you've got growth and real growth actually doing relatively well, which we now know was the case for last year because of fourth quarter GDP, that tends to not really be that inflationary, especially when you have productivity growth coming back. Doesn't really argue for a lot of cuts. So I think the language around that is going to be most important to watch for.
I like that. I'm generally in the camp, too, that the ranking is tech up first, because the market seems to be in a little bit of tension with the Fed, but kind of more like a win, not so much an if. Everyone agrees no more hikes, it seems like, so you'd have to have kind of some real surprise. Then within that category, when it comes to like Alphabet, Apple, looking at Amazon, too, what's your highlight, Joe? What do you think here is the most important name over the next couple of weeks?
That's interesting, Oliver, because I think from a valuation standpoint, believe it or not, I mean, Meta is actually fairly cheap from a PEG ratio, from a price to earnings to growth. So, that one I'm kind of keeping an eye on because it's pushing to new heights. I think Microsoft is important as well, too. Amazon, the story behind that is whether or not, it's going to catch up with the rest, because I don't think you can look at the mega caps the Magnificent Seven and kind of group them all together. I mean, Amazon's been an underperformer, and we know Tesla has been an underperformer, specifically after the earnings from last week. So it's really going to be the ones that have seen the most growth. NVIDIA, we got a couple weeks before we find out from that, but AMD, not part of the Magnificent Seven, but you could make a case that it belongs there now. Maybe it supplants Tesla, who knows? But you can make a case that that's really important. And one of the things that I noticed today is, even given a little bit of the chip weakness, it did seem like it was bifurcated amongst the chip stocks. It wasn't, you didn't see a big pullback in NVIDIA, AMD. It was more so stocks that might trade a little bit more in sympathy with Intel. Intel's still not in the AI space to those two.
Yeah, well said. And last point, Kevin, looking at your notes where you talk about the cash on the sidelines narrative. You want to clear some things up there. Take me through it.
Well, it's really just to push back on the notion that, you have to have this massive drawdown in the so-called cash, for the equity market to go higher. It's really not been our view. And there's a host of reasons. You could point to the fact that even as you've had this relatively quick buildup in cash, the money market assets is really what we're looking at. The market's done well at the same time. Even if you were to draw down that cash pile, there's no hard and fast rule that has to go into the stock market. There's plenty of opportunities in fixed income. And then just the perceived firepower of that alone, you look at the buildup in money market funds in assets and then take that as a percentage of the S&P's market cap. It hasn't moved in 10 years. So there hasn't really been this buildup of firepower because the market's grown so much. I think that's really important to keep in mind, because it's still a narrative floating around out there, and it could be drawn down, but it doesn't have to move inversely with the stock market itself.
Yeah, like that. All right, good stuff. Appreciate the thoughts, gentlemen. Nice close to the week here. Joe Mazzola and Kevin Gordon.